Good morning. Welcome to Monday's Trading Hour. I'm Reema Tendulkar. With me is Vinny, and the downside momentum for our markets continue for the fourth day in a row. The Nifty is at 23,300, down over 0.5%, down 135 points on the Nifty. The Sensex is down close to about 400 points, and the pain is so much more in the broader markets. Though we have recovered from the intraday low, and it's many of the banks like an IndusInd Bank and an Axis Bank. These are stocks which have recovered from the day's low, but still, look at the broader markets and the pain there. The mid-cap index has now moved to the day's low, and it's down close to about 1,000 points. And the advanced decline ratio tells you the story at 1:5. One stock advancing for 5 in the red.
Absolutely. So, a dull day coming in for the markets today. Nothing exciting. And 4 days, like you're saying, you're seeing a decline coming in. And a lot of stocks also that we're seeing, and all the sectors actually, Reema, today are trading in the red, led by realty, that's down more than 3% as well. We had metals that also down a 1.3% in trade, and individual stocks also that are falling in trade with Kalyan Jewellers, Adani Wilmar, Gland Pharma, Loda, that's Macrotech developers. So real estate names clearly under pressure today. While on the flip side, we do have some of the names that are holding on to gains. So we have Aegis Logistics, Piramal Pharma, Biocon on the back of news flow, which is managing to hold on to some bit of a green today. But other than that, all the sectors, Reema, today, nothing exciting that is happening on this front in the market.
Indeed, crude prices have inched to $81 per barrel. The dollar index is pushing towards 110, and you've got a severe weakness coming through in the global markets. The Taiwanese market has a cut of more than 2%. So all these are factors which is pushing the markets lower. But let's talk about Just Dial, because that reported their numbers and the stock has taken a tumble today. It's down close to about 7%. Now, here are some of the key reasons why. One, the revenue growth for the company has slowed down. Revenue growth stands at 0.9% on a quarter-on-quarter basis and 8.4% on a year-on-year basis. But look at the trend. On a quarter-on-quarter basis, the revenue growth for the company, which was hovering between 1 to 3% over the last couple of quarters, has slipped further. Even the revenue growth on a year-on-year basis at 8.4% is in single digits for the second consecutive quarter, and it was in, it was at 13% in Q1. In the March quarter, it was close to about 16.5%. In the December quarter of last year, it was nearly 20%. Secondly, collections growth for the company have also slowed. The management's aspiration was 10 to 15%. In comparison, in 9 months, the collection stands at 5.6%, and that's reflecting the monetization challenges. Margins for the company have inched up, but that's on account of reduced employee headcount. So margins are looking smart at 30.1%, but Ambit says this lack of investment in sales force and marketing has started to impact collections growth. Persistent sub 10% billing growth as the company is targeting margin maximization is the key sell catalyst, according to them. They prefer India Mart. They've got a sell rating on Just Dial with a target price of 1,037. Bear in mind, this is a company which is a cash of more than about 5,000 crore rupees.
Absolutely. So that's Just Dial that's in focus. But another stock that we should be talking about, and this is on the back of its earnings, we have PCBL that's in focus today. PCBL as of now is seeing a decline of almost 6%, recovered from the day's lowest point, but still down 6%. Upasana is here to tell us how the numbers were looking like and why is it under pressure specifically.
Well, revenue for the company stood at 2,010 crore with an uptick of nearly 21% on a YoY basis. Now, this revenue growth was mainly led by company's key segment, that is carbon black, which forms nearly 80% of the company's sales mix. Other segments such as power and chemicals did show growth potential, and mind you that the chemicals segment is a new revenue stream for the company this year. Now, coming to the key pressure lies in company's margins and profits. Margins have seen a decline of nearly about 90 basis points, stood at 15.9% versus 16.8%. And coming to company's profits, it has shown a degrowth of 37% on a YoY basis. It stands at 93 crore. Now, profits have impacted mainly because of 5x surge in company's financial cost, and even the company's depreciation has doubled up, denting some pressure on the profits. Now, company has also said that it is expecting significant growth in international sales volume in European markets, and has also highlighted that the demand for specialty products continues to be resilient. So all in all, the pressure clearly lies on the margins and the profitability of the company.
Thank you very much for that. Some pressure on Avenue Supermarts. Stock is down nearly 3%. Mangalam is here with the highlights.
Well, the company reported its numbers over the weekend, and importantly, there was one positive and two negatives. The one positive was the revenue growth that came in around that 18% mark, led by the company adding new stores, DMart Ready growing around 25%, and the same-store sales growth coming in at 8.3% as well. But a large part of that positivity was priced in because in the prior week, when the company reported its operational update for the third quarter, the street liked this 18% revenue growth number, and the stock rallied about 10% on that day itself. However, the two negatives, one was on the margin front, where the EBITDA margin compressed by about 60 basis points, led by an impact of 20 basis points each on gross margins, operating expenses, and employee expenses on account of the following factors, which the company believes has impacted margins. One is the increased competitive intensity because of discounting that we've seen by FMCG companies and other value retailers, the QCOM impact, so to say. Second would be the increase in number of stores that they've had, 22 stores in the first 9 months of this year. And the third more important factor is that their product mix, the assortment mix, is still not significantly changed at 23% of apparel and general merchandise, which are all margin accretive. And that brings us to the third negative, which was the uncertainty around leadership, because in a surprising move, Neville Narona has decided not to renew his contract, which ends on 31st January 2026, and will step down from the company as the MD and CEO in a year from now, for which the company has announced Anshul Asawa as the successor, the CEO designate. Anshul has been with Unilever for about 30 years, currently serving as the country head of Thailand. So how the leadership transition takes place is something that the street will most definitely keep an eye out on. Brokerages have written on DMart as well. Citi has a sell rating. They've said that over the last 10 quarters, 9 out of 10 quarters, the EBITDA growth has lagged revenue growth, implying margin pressures for the company. Bernstein has said that the third quarter SSSG was strong at 8.3%. But remember, there could be an element of festive season and uplift. So over the next couple of quarters, there could be limited SSSG growth for the company. And Morgan Stanley has said that management commentary in recent quarters has actually raised doubts among investors about DMart's growth algorithm itself. So we'll keep an eye out on that. And JP Morgan too has cut its target price to around 41.50 on the stock.
Okay, thank you so much for that, Mangalam. But on that note, and let's move on, it's actually time for Growth Code. That's an initiative by Grow and CNBC-TV18 designed to provide you with valuable trading strategies. This week, CNBC-TV18's Nigel D'Souza sat down with Praful Kulkarni, founder of Alpha Leo Capital, to understand why is the ability to adapt the market conditions critical for long-term trading success.
Why is the ability to adapt to market conditions critical for long-term trading success?
Market works in cycles, market works in regimes. Certain regimes work for certain trading styles and certain regimes are not so conducive for one particular trading style. So once you identify the regime, that kind of determines your stance for that particular regime. That is, every trader has a period of going very aggressive with his approach versus he'll be forced to being defensive in his approach. So when the regime is conducive to your particular trading style, the trader has to push on the gas and he has to go aggressive. And once he determines that, oh, this regime is not completely conducive for my trading style, he has to focus more on not giving up the money that he has made in the regimes which were conducive to his style. So this kind of determines the profitability and ensures the sustainability in the long term. Because market gives opportunity to every kind of trader at least few months in a year.
Welcome back to Trading Hour on CNBC-TV18. Let's shift focus and talk about the commodity space, specifically crude this time. Given that we've seen that continued rise coming in for crude prices, and today also Brent crude is at 81 and above that mark. So let's go across to Manisha to get in more details on this one. Good morning, Manisha. Crude is up and away.
Oh, absolutely. It's on a boil, clearly. We are looking at nearly 2% of gains in the Asian markets right now. Last week was a 6% of a jump up. And with that, if you look at this year, the crude oil prices have gained up by nearly 10%. Well, last 3 weeks, consequently, we've seen gains coming in. And this is the fourth week that the prices have started on a very positive note. Well, the reason that you have seen such big surge happen is that US has now put various sanctions on Russia. Earlier, it was various other individuals and sectors that Russia has seen sanctions on. But this time, this is really stringent when it comes to oil and gas. So what the U.S. Department of Treasury has done is that it has put sanctions on various oil and gas companies, CEOs of 5 oil and gas companies as well. 200 entities and individuals have been put sanctions on. We also understand that 183 vessels shipping Russian oil also have been put sanctions on. And then apart from that, the Russian insurance companies also face sanctions. I mean, this starts as early as immediate effect as well. There are also reports suggesting that UK will be joining in with US with these sanctions right now. And there could be a wider implication as we see, especially in the Asian markets, because much of the Russian oil was coming into China and India. I mean, that is something that the ministries are looking at this point in time. In addition to that, the crude oil prices in any case were rising because Saudi Arabia has increased official prices for Asia from Feb onwards. You have cold weather demand that also continues. And then the markets are looking at lower supply and exports from OPEC for the month of December. So that clearly adds on to further gains coming in for prices. And the expectation is that we're already at 81, 84 and 85 kind of levels is what the markets are talking about now for the month of Jan itself.
Thank you very much for that. This is one of the big factors for the market's decline and the weakness that we're seeing today, the rise in crude prices. Get into a break. On the other side, we'll get a corporate conversation going. Ranbir Singh from GNA Axles will join in on the other side to talk about the quarter gone by. Welcome back. Let's invite the management of GNA Axles on our show now. The company has reported a steady set of earnings in Q3. The company's top line has gone up by 5% in Q3. On a 9-month basis, the revenues have gone up by nearly 2%. There is a margin expansion as a result of which the net profits have gone up by 13% in the current quarter. Ranbir Singh, Managing Director and CEO of GNA Axles, is now with us on the show. Mr. Singh, morning and thank you for joining in. This is Rima here. So it's still slow growth, right? 5% for this quarter, 9% so far in FY25. Can you give us a breakup of the domestic market, tractors, how it's performed, and even the exports, Europe in particular? What were the key highlights?
Rima, very good morning. And thanks for inviting me in CNBC-TV18. Regarding our Q3, we have logged. It was slightly better than last year. As so far as overall for first 9 months, it's not a great improvement, but some improvement is there in the margins. Regarding the market scenario in India, if you consider this domestic CV and tractor market, both are flat for first 9 months. Even CV, the only positive thing is that in Q3 CV, they were able to reduce their finished stocks. Instead of those are 55 days against 90 days. So they are anticipating slightly better production and sales in Q4. As of our tractor also, there is a good outlook for Q4. If we talk about the North American market, it is a plus by 15%, 15 to 20% than normal. And Europe is down by 15 to 20%. And plus Europe, especially the Germany and large economy countries, they are heading for a recession this year. That is what they are anticipating. So that's why our overall sales is not growing because domestic is flat, CV is flat, domestic tractor is flat, and Europe is down by 15 to 20%. Only North America is up by 15 to 20%.
Right, Mr. Singh. Good morning. This is Vinny joining in the conversation as well. So you're highlighting that, Europe still continues to be under pressure. That's fallen almost 15%. So then this subduedness is expected to continue through FY26, given the indication that you're giving. And what is actually leading to the bit of an improvement in terms of margins? So 2 questions there.
Yeah, regarding the European market, it is anticipated because their financial year is from January to December. So this whole year they are anticipating the recession in this year. There is a transition in the gas supplies also. They have stopped from Russian area. So they are buying the more expensive gas and inflation is going to up. They are also they will face, at least during this transition period, this 1 year, they will face recession. Regarding our margins, we are this Q4, we have a good visibility, and we will be able to improve our top line also. And in this year, we are anticipating to improve our margins between 10 to 12% as compared to last year.
Any numbers, Mr. Singh? You're saying in Q3 revenue growth should pick up. Are we looking at high single-digit kind of a revenue growth? And what would be the exit margin range?
Overall growth will be between 4 to 5%. Margin growth will be 10 to 12%.
Okay. And sir, just want to understand in terms of contribution that you have coming in from EVs at this point?
Yes, we are developing our components, similar components, and same category for same customers also, for new customers also. What we are targeting by 2030 will be our revenue from LV and EV will be more than 10 to 15%, more than 15%.
And when that happens, sir, will there be a change in the margin profile of the company?
Definitely in new segments, wherever we are entering into, those are with better margins.
So say in 3 years down the line, sir, what could the margins look like for the company? Could you inch up to 15%?
Actually, at this moment, our margins have dropped to 13.5 to 14%, which used to be 15% in EBITDA margins. So we are targeting 15 plus in the next 3 years' time.
Okay, so you want to revert back to 15% plus margins over the next 3 years. You spoke also about an improving outlook for CVs and tractors. I mean, you have visibility for Q4 at least. So in Q4, what would the domestic growth look like for you?
Domestic growth if we say take the average of 9 months, domestic growth will be minimum 10% as compared to last 9 months.
So Q4 growth will be 10%?
10%
No.
as only Q4 growth will be 10% in domestic market.
Okay, in domestic market, you're expecting a 10% growth coming in Q4 is what you're watching out for. So I just want to take and highlight, last time when we had spoken to you, you had said that you're expecting FY27 and onwards a revenue growth of 8 to 10%. Does that still stand, given that we could see that weakness coming in the global markets?
In spite of weakness in the global market, we are mitigating our risk by adding more customers and more product range. So we are planning to, we are expecting the same growth, 8 to 10% from year 2027 onwards.
So 4 to 5% FY25, 10% FY27. What about FY26? Somewhere in the middle.
Actually, baseline has grown quite high, so we cannot expect more than single-digit growth in years to come.
Okay, Mr. Singh, thank you so much for joining in with us and giving us an insight in terms of the outlook that we could be expecting for Q4 as well as FY26 and FY27. That was the management of GNA Axles joining in with us on the show.
Thank you very much, Vinny. Thanks.
Thank you so much. Stock as of now down almost 3% in trade though. European market is something that is a pain point that is coming in for the company. But on that note, we're going to slip into a very short break. Don't go anywhere, because after the break, we'll return back and discuss the markets. So with Soni Patnaik on the technical front, so don't go anywhere. Welcome back to Trading Hour on CNBC-TV18. The market's not doing anything exciting. Nifty is below the 23,250 mark just as of now, down 0.8%, and underperformance continues in the broader markets. But a bright spot coming in today in the markets is coming in from Biocon. That's managing and surging in trade today, actually managing to hold on to good gains. At one point of time, it was up 4%, still holding on to gains of around 2.5% in trade. Why is that so? Now, they've gotten the US FDA clearance coming in for the Malaysia Biocon Biologics facility, which is the insulin facility of the company. Now, this is what everyone on the street was waiting out for, because in 2023, first they received an OAI, that's an official action indicated for this facility. Then in 2024, what happened was that there was an inspection that was carried out in this facility, 5 observations that what they had received. And now, finally, the company has gotten a VAI, voluntary action, that is indicated, and this paves a good pathway for Biocon Biologics in terms of the growth going forward. Paves way for, in terms of new launches that are expected coming in terms of generic aspart from the company in the near term is what we're watching out there. Other than that, potential launch of couple of drugs coming in, ustekinumab, which is expected in Feb 2025, and a potential launch of another drug is also there, bevacizumab, which will be also launched. So important drug, biosimilar launches that are coming in from the company. Regulatory hurdles are behind them. 2 clearances have come in the recent time. The Bangalore facility for Biocon Biologics, that has also gotten an approval clearance, as well as now this Malaysia one. So analysts are giving it a thumbs up. They are anticipating around sales from generic aspart in the range of around $25 million in FY26, and thumbs up coming in for this one. That is why the stock is buzzing in trade, Reema.
Motilal Oswal today has upgraded the stock to a buy, and they've put a target price at 430. So that's about a 17-18% upside from current levels. A Motilal Oswal upgrade to a buy on Biocon on the back of the regulatory boost that Vinny was talking about. Let's go across now to Hormuz, who brings us all the top brokerage calls that we've seen today. Hormuz.
It's very difficult to find some bright spots in considering the broader market pain that we are witnessing currently. You can't necessarily call BSE a bright spot, but the stock is still up because Goldman Sachs initiated coverage on the stock with a neutral rating and a price target of 5,060, which is already lower than what the current market price of the stock is. Now, what it says is that BSE stands to benefit from the strong growth tailwinds that India's capital markets currently have, and the nominal growth, the strong nominal growth in corporate earnings will act as a big tailwind or a big growth trigger for its trading revenues, which forms a majority of BSE's revenues going forward. What it also says is that because of the fact that BSE's valuations are trading at all-time high levels, considering the run-up that it has seen, the risk-reward remains largely balanced, and hence it has a neutral rating on the stock. And nonetheless, though, stock still up 1.5% at a time when the broader markets are currently bleeding. On the other side, Hyundai has received 2 more initiations in today's session, both of them being buys, and one of them coming from HSBC, a 2,200 rupee price target. It said that it is well positioned to benefit from the long-term growth in the Indian auto sales, and it has also a strong global parent, a local brand positioning as well, and new launches and the capacity expansion that comes in, particularly from the Talegaon plant, that will drive growth in the next 2 to 3 years. But weaker than expected model launches is a key downside risk that HSBC is highlighting for Hyundai. On the other hand, CLSA2 has initiated coverage with an outperform rating at 21.55 price target, where they say this one of the few foreign car makers who have survived the domestic market competition over the last 2 decades, and the capacity from the Talegaon plant will act as a key growth trigger starting FY27. So 2 initiations on Hyundai. Majority of the analysts still have a positive stance on the stock, although it remains below its IPO price.
Thank you so much for that, Hormuz, and giving us those insights in terms of the brokerage notes coming in on that front. But let's move on and also see if Sunil Patnaik is joining in with us from JM Financial Services to give us a quick view in terms of the market technicals, what they are looking like, because 4 days of fall coming in, Sony, as of now, today's low is 23,174. What are we watching out for in terms of levels for the Nifty?
Yeah, hi, good morning, Vinny and Reema. Thank you for having me on your show. So I think the morning bounce back that we saw without breaking the gap down low, that's important even on a closing basis. So if Nifty holds on to the 23,170 and 150 mark on a closing basis, there's a possibility that we can see a small bounce back. However, the resistance grows stronger towards 23,500 now. And as this range remains, there's a possibility that it may even slide lower and test the 22,800 on a positional basis if the 23,500 resistance is not taken out. I think selling pressure continues. We cannot ignore that the few parameters are getting into oversold zones now, technical and derivative both combined. So there could be a possibility of a short covering move anytime around the corner. However, timing that short covering is a bit difficult as market seems to be losing that strength in the morning that we saw with the recovery that we saw. So possibility of maybe test the lower support levels and then see a bounce back from those levels levels can be more stronger. Similarly, if we talk about Bank Nifty, 48,000 is an important support, and Bank Nifty especially is at extremely oversold zone. So if it's able to hold on to 48,000 levels, we may see it, heading higher towards again 48,600 to 49,000 level. That's a resistance zone. Now, if it crosses that, then a short covering bout can come. However, as of now, sell on rise structure still continues for both the indices.
Markets are again under pressure now, so we're moving towards our lows. Not yet there. The low today was 23,172, but there has been a selling pressure, at least in the last 45 minutes, from the little bit of an intraday recovery, so that momentum has faded. What would your stock calls be, Soni?
So Rima, I'll have a balanced approach, a buy and a sell recommendation. The sell recommendation is an ICICI Bank futures. One can sell on rise up to 1245, keeping a stop loss of 1272 and a target of 1204 to 1170 can be seen. So it's a positional sell call that has been recommended. This buy call is in TCS. IT is already continuing in the good momentum. TCS has built up good positions on an intraday basis as well as last week that we saw the Friday's close. So one can buy in TCS at current levels, keeping a stop loss of 4200 and a target of 4420 to 4460 can be seen.
Okay, Soni, thank you so much for that, and thank you so much for joining in with us. But let's move on, and Yash is joining in with us to give us a roundup of the December 2024 life insurance business update that has come in. Yash, good morning.
Well, good morning, Vinny. So as far as the numbers for December, as far as the life insurance industry is concerned, not much noise around any of the companies, very quiet numbers for the month, except for little excitement and action around SBI Life Insurance on the upside. So I'll take you through the numbers. Life insurance industry, the December premium is down 22%. For 9 months, it's up 10%. And in the month of December, it's down 22%, largely dragged by the largest life insurance company, that is LIC. Private life insurance companies, December premium is in the positive zone, but not much action, up just about 7%. 9 months FY25, up 14%. December total APE, up 11%. December retail APE, up 11%. Now let's speak about individual companies. HDFC Life Insurance, weak growth on a favorable base. December premium down 5%. First 9 months premium up 11%. December total APE up 8%. December retail APE up 12%. ICICI Prudential Life Insurance, modest growth, but on a strong base that it had. December premium up 4%. 9 months premium up 31%. December total APE up 11%. December retail APE up 9%. Axis Max Life Insurance, modest growth on a decent base. December premium growing by 3%. First 9 months premium up 16%. December total APE up 7%. December retail APE up 11%. SBI Life Insurance, as I said, some excitement around that company. Strong growth on a strong base. December premium growth of 15%. First 9 month premium growth of 1%. December total APE of 16%. December retail APE growth of 16%. Finally, LIC, weak growth on a favorable base. December premium down 41%. First 9 months premium up 7%. December total APE down 27%. And December retail APE also down about 13%.
Very comprehensive. Thank you very much for that. We will slip into a very short break. On the other side, we'll discuss market fundamentals. Rakshit Ranjan from Marcellus Investment Managers joins in next. Welcome back. It's now a 1,400 point fall on the mid-cap index. When we started the show at 11 o'clock, the mid-cap index was down 1,000 points. And as you can see, the slide continues. It's getting very, very ugly. The cuts are deep. PCBL, a stock that we spoke about, 7% gone. RVNL, one of the big movers over the last couple of days, that's lost close to about 7%. Kalyan Jewellers has been weak this month itself. Since the beginning of the year, the stock is down nearly 24%. Adani Wilmar is another stock which is under pressure. Oil marketing companies are reeling with weakness on the back of the rise in crude prices. So HPCL, IOC are down 5 to 6%. Swiggy, another big wealth creator, ever since its short listing, it's been on the last street not for a long time, but Swiggy has corrected close to about 5%. MobiKwik, Paytm, some of these new age tech companies too are the casualties in today's broader market fall and the pain that we're seeing. Rakshit Ranjan from Marcellus Investment Managers is now with us on the show. Rakshit, it's been persistent weakness now for nearly 3 to 4 months. What are your thoughts on it, and what has been the approach in this fall that we've seen?
Good morning. Thanks for having me on your show. So yes, you're right. There's a very tough economic environment out there. Although corporate balance sheets in general are in a good position compared to, say, a decade ago when we had an economic downturn, but this time household balance sheets are under stress. Government spending has moderated significantly. Currency, fiscal deficit position, etc. It's all flashing weakness signs on several parameters. What we are doing to the portfolio in the last 12 months, we've added exposure to several areas where some of these economic factors are not going to play a role. So, for instance, export-oriented companies, IT services, I would say healthcare, pharma, hospitals, diagnostics. These are some of the areas where I think you can call them macro-oriented safe haven in the current environment. But otherwise, if you've got companies with market share gains and prudent and good capital allocation decisions to grow earnings, only then can you expect some resilience in the share prices. Without earnings growth, it's going to be very difficult because the macro is against most businesses.
But do you expect the domestic macro to remain subdued through the course of this year, or are you anticipating a turn? At what point should one start looking at the domestic facing economy stocks?
No, that's a very, very big question. Signs of a turn in the macro environment aren't visible yet. There is a possibility that a couple of years down the line, there might be some resilience in certain parts of the economy, particularly maybe staples and all. The base effect might become a little favorable for certain areas, but I think overall, I don't see government spending, job situation, and hence some of those parameters recovering anytime in the next couple of months. So earnings growth more from capital allocation and market share gains, I would say would be the best bet in areas which are exposed to macro headwinds.
Sure. So earnings growth is something that you know is a key factor that you're keeping an eye out on this year. What is the earnings growth that one could actually anticipate during this year? Any number that you all have calculated as of now?
Yeah, so not so much for the broader market, but let me give you some sense. So last 2 quarters or first half of FY25, the reported first half, our consistent compounders portfolio saw a blended average earnings growth of 17% versus the market's pretty much flat, if I'm not wrong, flat to maybe positive 1 or 2%. So that kind of a difference in earnings growth can give you resilience over the next, say, 12 to 24 months. And this is largely, again, because the companies in our portfolio. So let's take some examples. So Divi's Laboratories, Trent. These are some of the larger allocations. Their earnings growth rates have been pretty healthy, margins expanding. Although in some cases, like say Trent, the macro is against on the consumption side, but the growth rate of the business continues to be healthy. So that's the example that I was giving about earnings growth. For the broader market, I don't think we should expect double-digit earnings growth anytime soon. Given the external environment, at best, they should be a mid-single-digit expectation for the broader market in the next, say, 12 months.
Right. Rakshit, what also I want to understand that, given that we've seen a bit of a fall coming in the market, actually not a bit, sharp fall coming in the markets in the recent time, anything that you're looking to add now, is there anything interesting coming in that one could watch out for in the consistent compounder portfolio?
There are several businesses, I would say, which had gotten re-rated up very significantly in some of the areas of the broader stock market that I talked about, but we avoided them. So there are some of the healthcare-oriented companies, for instance, which had skyrocketed up on valuations. In an environment like this, those companies correcting is an opportunity that we'll be looking out for. Also, in a portfolio where there's more uncorrelated exposures across stocks, rebalancing becomes a massive opportunity every time there's a market dislocation, because there'll be some parts of your portfolio which might correct a lot more than others. And these opportunities add a few basis points to the long-term compounding of a portfolio like this. So looking forward to rebalancing, and some areas where valuations have corrected or will correct in a meaningful way to make them attractive for us to buy.
So for those who aren't, who aren't tracking the consistent compounders or all the Marcellus portfolios, can you tell us some of the recent additions in IT, pharma, healthcare, diagnostics? And is there still value? For instance, IT has seen such a fantastic run-up in the last 6 months, despite EPS downgrade. So is the best priced in at these levels?
Well, again, IT has a very broad spectrum of valuations at the moment. The stock that we've added in our portfolio is HCL Tech, because we see HCL Tech being better positioned both compared to say a TCS or an Infosys on fundamentals, as well as better position compared to some of the mid-tier IT companies on valuations. So that's one addition there. So you have to be selective. It's not that all companies will grow earnings and all companies are equally attractive on valuations. But yes, companies where there is more relevant focus from a future IT services growth perspective in terms of the overall portfolio, and these trends are not something that, let's say, a GenAI or any tech disruption can actually take away or dilute. I think those are the areas where we've added. In healthcare, about a year ago, a little less than that, we added Narayana Hrudayalaya, which I think over the next 2-3 years should see a significant uptick in the fundamentals momentum. So those are some of the names over the last 6 to 12 months.
Do you see value in HCL Tech at these levels after the run-up from 1,600, 1,500 to nearly 2,000?
Yeah, I think HCL Tech, we see beating expectations, both its guidance as well as broader stock market expectations in the next 6 to 12 months. We also see HCL Tech sort of undergo an acceleration on a relative basis compared to several other larger tech companies in the Indian IT services space, and hence from a timing perspective to add, yes, this is a far better proposition compared to some of the others.
Okay, Rakshit, thank you so much for joining in with us and giving us your view there. But on that note, we're going to slip into a very short break. Viewers, don't go anywhere. We'll be back with more updates after the break.
Welcome back. All eyes will be on HCL Tech as it reports its numbers post-market hours today. Now, we're expecting a good quarter. Revenue growth for the company is seen up by about 3.2%, and this is a seasonally strong quarter for HCL Tech. They have services and products. So services will be similar to the other companies, but product is where you drive that seasonality comes in, and this will, it shows up. So in Q3 of last year, the revenue growth was about 6%. In Q3 of the year prior to that, it was close to about 5 to 6%. So in a nutshell, Q3 is a good quarter. We're anticipating about a 4% constant currency revenue growth. Margins for the company consequently will expand to 19.5% versus 18.6%, and they will be able to absorb part of the wage hike impact. And the improvement in margins will drive about a 9 to 10% increase in the profitability. But the key will be, can HCL Tech up its guidance? So the current guidance stands at 3.5 to 5%. If you look at some of the estimates on the street, many believe that the company was conservative when they gave the 3.5 to 5% guidance. Maybe the lower end gets upped. So perhaps the company guides for 4.25 to 5%, 4.5 to 5%. But what will excite the street is if the upper end of the guidance is likely to be upped from the current 5%. If that happens, that will be taken very positively. Margin guidance is likely to remain unchanged at 18 to 19%. The stock has been an outperformer in the last 1 year. It's up nearly about 30%. And we just heard Rakshit Ranjan also saying that HCL Tech is relatively better placed fundamentally and even on the valuation front versus some of the large cap peers. So all eyes on HCL Tech. Their press conference is at 6:15 p.m. So numbers should be out just prior to that.
Okay, surely keeping an eye out on HCL Tech. But with that, it's a wrap on this edition of Trading Hour on CNBC TV 18. Thank you so much for tuning in. Don't go anywhere. Up next, you have Halftime Report.